All right. Well, thank you everybody for joining today. We'll go ahead and kick things off, and the recording will be sent out after for anyone who joins late. We've got a fun session lined up today. I think we're going to really be focused on this perspective coming from three different perspectives on the venture capital side of what these guys are seeing in the marketplace and how you can stand out if you are looking to raise capital or get involved investing here in 2021. So let's kick off with some introductions, and then we'll jump into it today. And we'll kick off with Scott Stettler. Would you mind introducing yourself and talking a little bit about your fund?
Sure. Yeah. So I'm Scott Stettler. I am the president and managing director for Wasatch Venture Partners. I'm also the CFO for Wasatch Property Management and Wasatch Premier Communities, which we have 17,000 apartment units across the West, approximately. And we also have the management company that manages all those properties that I play the CFO role over. But about 8 or so years ago, it was natural for us to incubate companies that fulfilled a need that we had in our multifamily management business. And so we incubated a few companies. One of them got extremely large. Conservice was a company that was incubated out of Wasatch, which became the largest utility billing and submetering company in the country. But we've also incubated Rent Dynamics out of a need for contact center, CRM, and rent credit reporting. And so what happened was, as we started to incubate these companies, other companies started coming to us in the prop tech space, particularly for multifamily, and they wanted our expertise in management to help them grow their business. So we started a venture arm within the Wasatch Group called Wasatch Venture Partners that I quickly moved into the role of overseeing that and working with these prop tech companies. And so now we've got several companies we've invested in that are usually focused on prop tech for multifamily, or prop tech for commercial real estate in general. And a lot of them, when we make our investments, they have synergies between the various portfolio companies so that we can really grow those companies quickly, as well as use our roll out the technology on our portfolio as kind of a test and to provide real-time feedback from our operators on site as to how the technology is working, if it's effective, if it's truly solving problems that they say it is. So that's where we're at today, and we just kind of continue down that path as opportunities come our way. So
awesome. Thank you, Scott. Nick, would you mind going next? Just a little bit about you as well as the fund.
Yeah, Nick Singleton, Vice President of AIM Ventura Capital. We're located in Logan, Utah, just down the street from Scott, actually. Our fund was founded by Greg Cole, who served as one of the companies Scott mentioned, Conservice. He was their CFO for about 15 years, was a big part of the growth there, joined when they had about 5 employees, exited with about 2,000 employees. So because of Greg's experience, we like to consider ourselves a little bit more hands-on investors. Greg spent 15 years in a high C-level position, and so he has a very big Rolodex of experience to offer, growing companies. So we like to consider ourselves a growth partner rather than, a venture fund. We will provide capital, but we also want to, step in and put our hands around things and help out with special projects, much like Scott talked about doing things with some of the prop tech companies. Because of that experience, we all also are invested in a number of deals in that space, but we also have invested outside of that space a little bit. We have a consumer products company called Gap Wireless and a few others that are outside of that scope. We're coming up on the end of our first fund, which was about $30 million, 11 investments, and kicking off the fundraising for our second fund. So thanks for having me today, Mike.
Awesome. Yeah, thank you. Anu, let's round out the panel and have you go last.
Thanks, Mike. Hey everyone, Anubhav Maheshwari. I'm a principal at Stage 2 Capital. We're an earlier stage focused VC, typically investing at call it the seed stage. I feel like we're going to talk about this, but naming conventions are changing all the time. But we like working with companies really early. We're all about go-to-market. We were started in 2018 by my partners, Mark Roberge and Jay Poe. Mark was formerly CRO at HubSpot, there from kind of founding team all the way through the IPO, helped scale that business. Jay was formerly an investor at Bessemer. And the thesis around stage 2 is wanting to work very closely with companies and helping them scale go-to-market foundations. And a unique way we do this is through our own network of LPs. The vast majority of our LPs are individuals who are go-to-market leaders themselves. So think CMO, CRO, VP sales, some CEOs, COOs, presidents at a lot of different public, private tech companies. If you go to our website, stage2capital.com/leaders, you'll see a lot of them. And we like plugging them into our companies as informal or formal advisors, one-off conversations, just depends on the context. And it's all about setting up the go-to-market motions that help a company scale from when it's got into that initial product market fit to go-to-market scaling. And we've been doing this now since 2018. Our first fund was about $15 million, invested in 11 companies. We're in the final closing process over Fund 2, which will be approximately $80 million. Already made 7 investments so far, and excited to find new companies to back.
Awesome. Thank you. And my name is Mike Wolber. I'll be the moderator today. I'm the Chief Revenue Officer of Rent Dynamics. Just relocated my family to Utah, and one of the first things I did was join the board of the Logan chapter for Silicon Slopes, and I'm really excited about today. To set the table also for the audience, we do have live chat. So if you have any questions for anyone on the panel or for the group at large, feel free to drop those in, and I'll make sure to sprinkle those in throughout the chat today. So Nick, let's start with you. I want to just kind of talk through the landscape. You look back at the last 14, 15 months, COVID and the pandemic really threw a huge wrench in the wheel for this past year, but it's also caused some crazy growth when it comes to tech. What have you been seeing from the perspective of an investor?
I know we hate continuing to use the word unique times, but it was kind of a unique year. I was new to the space. I joined AIM the beginning of 2020, so had maybe 2 months of normalcy, and then it kind of got a little bit funky. And what we kind of saw was, a pause on things in March and April while COVID got kind of, taken off, and people didn't really make decisions then. And then I felt like, May and June hit and things kind of just hockey stick from that point. Valuations went up, deal flow went up. I think the one thing that, it just accelerated things. We've been seeing non-traditional capital come into the market, over the last couple of years. And I think COVID just escalated that. And I attribute it to people sitting at home, having more time on their hands. So I think it did 2 things. It's like, hey, I need to find something else to do with my money. So they looked for alternative areas to place money in asset classes that they usually can't. You're seeing people like Assure and Sweat are the VC asset class to an investor that typically couldn't invest in, that because they couldn't qualify for a fund or write a big enough check to be a part of that. So I think you saw that grow more, but you also saw deal flow grow because those people sitting at home, unhappy with their job. I think I read a statistic a few weeks ago that 41% of people considered quitting their job during COVID because they realized, that they were miserable at their job. So I think we saw more and more businesses be born in that. And I think we're going to continue to see that trend for the next, 12 months to 24 months. So, the 2 biggest things was increased deal flow and valuations continuing to grow because of the amount of capital coming into the market.
Anu, thinking from your perspective, you're the only member that's not living in Utah. Any different perspectives there, or things you're seeing in your fund or in your portfolios?
Yeah, so Stage 2 is unique in being a remote first firm, and we have been so since our founding. I'm currently based on the West Coast in Seattle for the time being, but will likely be in San Francisco later this fall. And we invest across the country. And I think a big theme that has emerged in the last, call it 12 months or so, is ability for companies anywhere to be able to meet with investors, to meet with customers, right? Because it's all virtual and you're not constrained, you're not limited by schedules in the way that people were in the past. And I think it's been really exciting because our team, since from day one, has been investing in companies all across the country as well as internationally. But it's become even easier now because we've just gotten used to doing deal processes, start to finish entirely remotely. And that has just opened up the funnel of the types of founders and entrepreneurs we're seeing. Historically, there's been a lot of activity in Silicon Valley, in New York, but we're seeing and investing in companies in Utah, in Texas, in Florida, Georgia, etc. So I think it's been a really positive change to be able to connect in a much more virtual manner.
Got it. And Scott, I mean, I think you're probably the most vertical focused investor of the group today. It seems like every week there's a new company trying to solve a problem in prop tech. Yeah. Are you seeing anything different as it relates to trends or topics that are catching your mind as a focused investor?
Well, I just want to echo what Anu was saying about, just we're getting opportunities that are coming to us from across the country. We just recently invested in a company out of New York, one out of Texas. We were in the past, we were pretty focused on the Utah market, and things have really opened up. But the one thing that I'm seeing on our side is just the strength of the multifamily real estate industry and the commercial real estate industry in general. I feel like that has carried over, and that excitement of the real estate industry has carried over into prop tech. And so as the excitement's been all around real estate, a lot of entrepreneurs out there and founders have said, hey, this is an exciting space. In the past, I think real estate's been seen as kind of sleepy, maybe a little bit behind the times, especially in multifamily. But I think the excitement around real estate lately has really excited these entrepreneurs into solving problems along the life cycle of a renter all the way through to a homeowner. So what we're seeing companies that are coming out of these accelerator programs that have a great idea. They didn't know how to do it. They didn't know what to do. So they jumped into an accelerator program, and we're getting introduced to them through some of these accelerator programs. And it's not how all the deals come to us, but we've seen a little bit more of that. And it's because they know they have a great idea in a hot industry. They just don't know how to raise money, how to go about getting it off the ground. And so we've seen more of that in the last little while.
That's great. So speaking of that, Scott, you just talked about, companies coming to you. Anu, I'd love to start with you on this one. As you think through inbound in your world, I can't even imagine how many companies come your respective ways throughout the day, weeks, and months of the year. What are some of the things that companies, especially right now with more capital and these crazy valuations, what can companies do just to stand out and to make sure that they get that first phone call and they can get a chance for, being considered?
Yeah, you're totally right, Mike. At Stage 2, we're in this privileged position given our extensive network of a lot of leaders sending us deal referrals. So we definitely see a lot of inbound. And I think the key thing that helps companies or their pitch decks or even sometimes, their short blurbs stand out is when they're able to very quickly explain, what are the core pain points that they're looking to solve. It's not just being, it helps to be in a hot category or one that's attracted either past or current interest. But what really matters to us is, taking that customer or user-centric approach. And the more quickly and better a company can really elucidate, hey, this is the pain point that we're solving. This is why it's important and why people want to, spend money or their time on solving that pain point using our product or service. That really helps them, stand out. So that's sort of number one is the pain points, what they're solving. And then after that, it's a lot of things that many investors look for, which is, hey, tell us about your traction. Tell us about your engagement. Are there signals that suggest that your hypothesis is right? Are you receiving those early customer or user engagements? And for us, we typically invest post product market fit, which means that we're not usually the first check, but often the second check into a company. And so for us, it's really important to see that thesis playing out with early customers and looking at things like user retention, customer retention. We place a lot more focus on customer success than potentially many other VCs that are focused purely on growth. And we try and think about, hey, is this growth sustainable? And usually that is informed by a lot of leading indicators of success, which are things like retention, customer engagement, et cetera.
Scott, you mentioned a couple things about, property tech and the life cycle of a renter from first leasing to eventually becoming a homeowner. Are there specific things that you're kind of focused on when you're doing evaluations that can help a company stand out?
Yeah, I want to just kind of give an example of kind of this, and I may be stepping back a little bit on your question, but I want to give an example of our last investment. The first call we had with the founder, our first impression was the TAM's too small. The total addressable market is too small, and we are probably not interested. And I'll tell you what makes these investments stand out for us is it's the people, right? We're investing in people. And as we continue to talk with these founders, we started to realize that they were brilliant. They're brilliant thinkers. And that initial TAM that we thought was pretty small, they had already created solutions that expanded their TAM significantly. And as we got more and more into the discussion, we were like, we want to invest in these people because they understand that if they were just focused on this one total addressable market, they understand they would not succeed. But they had already thought through it. They had thought years in advance on how they were going to expand their markets and create partners within the industry to expand that TAM. And so for us, that thinking of, not just I need a check today to cover my payroll, I need funding to grow my ideas and to execute on the ideas that I have. And up to this point, I have sacrificed blood, sweat, and tears. It hasn't been just this easy road and I'm going to raise money. They have sacrificed, they haven't overly compensated themselves. And they've really kind of put that time in and that thought. That's what stands out to us when we're investing. Does that answer your question, Mike?
Yeah, I mean, I heard from Anu, it's all about the pain points you're solving, user engagement, CX, post-product market fit. And I think from you, importance of the people, being able to tell you that story, not just of the short term, but the long term. That makes a ton of sense. Nick, anything you'd add? I mean, that was a pretty long list, but I think being able to stand out, I mean, it's a noisy world right now with social and email, and we're all still either in office or maybe still transitioning. What are folks doing that helps them stand out from your perspective at AIM?
I would say kind of, Anu and Scott kind of hit the head on the nose, especially Scott, today, with so many deal flow increasing, like we've talked about, looking at the key teams is the most crucial part for us. And we've kind of took an approach of getting to know founders early on. Like Anu, we're not usually the first check-in. We want to see some revenue generating through the company. And so if I can meet a company when they're raising their first, maybe their seed round and, 9 months later, they're going to be ready for an A round, and I can casually get to know them over those 9 months, specifically after they've gotten some capital and seen what pain points they've experienced with a capital provider, the decisions they've made as a founding team, and kind of casually get to know them, whether that's through, a game of golf, a couple lunches, once getting together with them once a quarter is where I found that it's really beneficial, and to see them. I would say as far as, making yourself stand out when you're reaching out to a capital provider like us is remember who your audience is. Scott and Anu and I don't know everything about everything. So remember, most of these founders are in the weeds building these companies every day, and they forget that they need to talk to investors from kind of a macro level. You tell us, simplify it for me in as few words as possible to capture me so that I want to look into the industry more or look into the company more, and I would say, to Scott's point too, not only on the management team point out your strengths, but I like to see a management team point out their weaknesses. There is no founder on the planet that is good as accounting, sales, operations, and everything. There's very few people that can cover everything. If you can point out to us where your weak spots are, and, like I said early on, we consider ourselves more of a growth partner. So if we can kind of see those holes and know where we can kind of step in and help, that's very beneficial to us.
So let's double click on something you said back there, Nick. One of the things that I wanted to talk about is if and how your maybe evaluation structure and process has changed, especially with the world pivoting to virtual and things like that. As we were prepping last week for this panel, we talked about the amount of time that all of you spend with the founding teams to make sure you understand them. But Nick, let's just circle back on that. As you look at that kind of evaluation process, either has it changed or what does that evaluation process look like? Would love to hear a little bit more about that.
Yeah, I think a few things have changed, and we've kind of already talked about them. Scott mentioned that, and Anu mentioned that, the amount of deals because of, a virtual world we live in now that we're seeing. I mean, in the last 2 weeks, I've gotten a deal from New Zealand and a deal from Toronto. And, I would say for us, it's kind of three things. It's, an increased deal flow. I want to look at more deals because there is more deals out there, but because of the increase in valuation, I want to see if I can find that diamond in the rough. Second thing that I mentioned is that longer due diligence process. And mainly that is getting to know the founding team and seeing what moves they make over time. And then the third thing for us, I think is the hardest thing, is staying within our investment thesis, And the hardest part for us is that revenue threshold we like. We want to see a company generating, $2 million a year in ARR. And we see things that come into, that are presented to us that don't quite hit that are really good companies. But we've found through our experience, we're still relatively new fund. We're 2.5 years into this, but we found that we're better investors at that point. So for us, that's probably the hardest of the three, is sticking to that threshold and investing in our thesis.
Got it. That makes a ton of sense. And we just got a question from Spencer Beard. And the question is, what then do you look for in a founding team when casually getting to know them? Scott, I'd love to start with you on that one. When you're looking to get to know a founding team, are there specific attributes or qualities or intangibles that you're looking for when you first meet with and get to know a founding team?
One of the first things we really like to get our arms around is why they're doing what they're doing. Is it because they're passionate about this, or is it because they want an exit check in 3 years? It's not that interesting to us to invest in a company where all they're thinking about, these founders are thinking about, is getting a check 3-5 years out. Because what we found is the founders that are have that operational mindset and even that goal to achieve cash flow and all those things, that naturally creates value in the company. So opportunities are going to come your way. You're going to become that really attractive company for so many out there if you are have that operational mindset and have goals to be successful and not just always live on fundraising. And so what we found is, if the founders have that mindset of, yes, we're operationally minded, we want to be successful, we want to get to cash flow, we want to grow this company, and we also want to make a difference in the industry we're in, that is attractive to us. So that's what we try to get to know first. What is their goal? What are they trying to accomplish? If the first thing they say is an exit, then we usually exit the conversation, because it's not that interesting, because we feel like there's a different management approach to someone that just wants to exit and get a check.
Yeah, that makes sense. Anu, I'm curious from your vantage point. Stage 2 to me is such a cool, complex fund. You've got a big network of LPs. You've built this remarkable community called Emerging Leaders Syndicate to really create education for venture. And when you're evaluating, founding teams, are there any specifics differing from Scott that you guys look for when you're getting to know those founders and their story?
I'll add on a few additional points, but I really want to highlight what Scott said initially earlier to one of the earlier questions about when founders really stand out because of who they are and their unique insights, right? And I think exceptional founders, it's hard to describe, but when you hear it, you feel it, and it's having a mix of that passion, a unique insight, and a drive, right? It's that very colloquial fire and belly analogy that we all like to use. And so that totally resonates with me and what we look for as well when we're getting to know founders. I think the piece I'll layer on is And something that's quite important for us is understanding, do these founders and teams have a growth mindset? And again, Nick said something really interesting too, which is, hey, tell us what you're good at. We want to hear that, but also tell us what you think you're not good at or want to get better at. And that shows a lot of humility. It shows a growth mindset and ability to want to learn and adapt. And that's really important to us too. Something we often try and do is challenge founders or give them suggestions on things. And we may not have the best suggestion, and in most cases it's not going to be, but we just want to hear how the founder responds to that. Is it something where they get defensive, or is it something where they thoughtfully piece a narrative about why a particular approach is a right approach? We do this in our own team, and we also like to bring in other folks from our network as well for outside-in perspectives on that same point, which is, how adaptable are you? And it really comes down to ability to be coachable and willing to hear advice. And that's something that's really important, no matter if a company is small or even a public company, right? And receiving input from a board or other members.
Absolutely. I want to kind of follow a thread that I think we all kind of started with in that conversation. And one of the things I'm curious about is, and I think the audience will benefit from this too, is when you get approached by a company looking to raise, what are some of the things that you expect or hope them to bring to the table? And not just TAM and NRR and these metrics that everyone typically fixates on, but things like their expectations from you, or like you just talked about, Anu, not just the things that we're great at, but the things that we're weak at. I think it'd be fun to have some dialogue, and you might even have questions for each other on this too. Nick, let's start with you. When companies approach you're getting to know the founders. What are some of the things that help set them apart as it relates to the conversations they're having with you and being clear on the expectations that they have of you as a future investor?
Yeah, I would say the number one thing, you're kind of hitting the point. I'd say the number one thing that stands out for us is an entrepreneur that interviews us as much, maybe not as much, but spends the time asking us questions of what kind of partner we're going to be. Like I said, our differentiator and what we claim is kind of our MO is Greg in a lot of ways. Greg has such a Rolodex of experience that he can provide to a team to kind of either hold a young entrepreneur's hand, help them build a team. And these are things we've done with portfolio companies and I use that as to our advantage when I'm pitching companies, and the companies that, continue to dialogue with me and want to know more about what we really do beyond our capital really stands out, because all money is green to a certain extent, but not all partners are the same. And that's the biggest advice I would give to an entrepreneur. Fundraising is difficult. Fundraising is probably the most difficult thing any of these business owners are going to do in a lot of ways, because it's so different than what they're experts in running their business in a lot of ways. They're not experts on fundraising. So that's my advice to every entrepreneur is do your due diligence on the type of investor that you're getting into bed with, because you're going to be in bed together for a very long time, typically, whether it's, 5 years to an exit or it's 10 years to an exit, you're going to be partners for a very long time. And it's advantageous to both sides to be a partner on that. So, and I think, stepping back, maybe when a company reaches out to me and they've done a little bit of homework on me and reference something, I got one 2 weeks ago that said, hey, I know you guys are investors in Homey, you're investors in Opinion, so it seems that you guys like the prop tech space. I'm, a prop tech entrepreneur. Here's my deal. Please. And they don't even come out of the gate and say, hey, we're raising money right now. They're seeking advice on their company sometimes. And that's kind of the best. That's happened a few times where they don't come out of the gate and say, I need money. They're saying, hey, you've been in the space. Can you provide me some advice back? And that captures my attention much more than getting a pitch deck in my email and saying, hey, I need some money. I'm a prop tech company. He did his homework on me. He asked for advice. And we've continued a good dialogue from that point.
Got it. So Scott, thinking through everything Nick just said and considering that you're so vertical focused, is there anything different from any of those kind of topics and key takeaways that help companies stand out specifically as it relates to making it clear why they want to work with you or any of those kinds of things?
Well, so first of all, I just want to say I completely agree with Nick and what he just said. That fits in so perfectly with how we invest and what we look for. One of the other things that we do pretty early on, and again, I just echoing what Nick said about them getting to know us, when they're asking us questions about what we offer, that shows some insight on their side, that they're not just looking for a check and not concerned about the future. Because I've always joked that I'm going to write a book in my retirement years titled Bad Partners, because they really are painful. They're very painful, and you can write books on some of the experiences you have with bad partners. So you don't want them. And if you do want to make sure they're thinking the same way. They're not just ready to partner with anyone. But one of the things that I wanted to say was, what I like to do early on is I will make introductions to our portfolio companies, and even before we've even said we're going to invest in them. And I'm part of the conversations, or someone on my team is part of the conversations, and I want to see how they react to that. I want to see if they look at that and go, that is a great opportunity, or if they're just like, oh, nice to meet you. Okay, yeah, we'll talk sometime later. But if they all of a sudden start to expand the way they're thinking with our portfolio companies, and they're like, oh, wow, we have these synergies here and there and there. Oh, yeah, we could partner this way. We could do that. Then all of a sudden I get interested, And I also look at, I also reach out to, we have a construction development company. We have managers on site that have pain points. We have, all of these resources of people. So I'll reach out to them kind of early and say, hey, is this something that would solve a pain point for you, or is it not? And a lot of times I'll get feedback immediately from someone from our construction or development company. They'll say, oh, there's 3 other software companies doing this, plus they do this, and then it's like, okay. But again, from the looking at the actual founder and the company raising money, if they can look at our portfolio companies and our real estate portfolio and the experience we have, and they can see the opportunity, that's interesting to us.
Got it. So I'm going to take a question that we just received from the live chat, and then I'd like you to take this one first. The question was a follow-up on kind of the evaluation of founders, and it's a cool question. Would you say that humility and disclosure is more important up front than the track record of each member on the founding team? So I'll reframe this. How important is the track record of the founding team? If someone's tried before and failed, or if someone's tried before and unicorned, what kind of component does that founding team's track record play in evaluations?
Yeah, this is a really, really good question. And I think there's not really one perfect answer, in my opinion. It's really that all of these elements have to be taken sort of in context of the founder, their experience, and who they are as a person. And it's important to often do things on a case-by-case basis. There's definitely statistics that have been tracked around the success rate of repeat founders, for example, I believe is higher than first-time founders. But I think that's just more indicative of that learning that the founder has gone through and ability to kind of figure out quickly, like, what are the things they need help with, and if they're tackling a new problem, a new market, what are some of the pitfalls that they won't do again. So I would say it's definitely important. It helps. But the way it helps is in coming to that conclusion on, hey, what is their growth mindset? Are they going to be able to replicate what they did in their previous successful venture or previous successful operational or investing role, whatever it may be, and do it again into the next venture? Something else important that I think I'll note is sometimes there are examples of individuals who have done really well previously, but later on, because of some issues, right? There's adverse issues that come up that could be just things that make for very messy board meetings, let's just say. And so it's really important to look at things on a case-by-case basis. Track record helps, but it's not the only thing. And I would go so far as to say that trying to get a sense of who they are as a person is going to be always sort of the number one thing. The track record can just help elevate that significantly.
Got it. Nick, anything to add to that, or did that cover that conversation of the importance of track record versus humility, likability? People like to work with good people, in my experience.
Yeah, I mean, I'd kind of echo that. Obviously, I like to work with people I like, and many, we've lucked out. Many of the founders and entrepreneurs in our fund have become, close friends of mine personally. I would say more so than the track record, and a new kind of hit on this was, I don't care if it's a kid fresh out of college or if it's an experienced entrepreneur that's been through it before. I want to know that they're an expert in their company, their vertical, and then they lay out a roadmap of where the company they think they can take the company. They don't necessarily need to know how to get from each step along that roadway. That's something that we can bring to the table and help them with. But if they can lay out that roadmap of where they're going, I think that's more important to us than track record.
Awesome. So I've got one question left before we wrap. And so I'm going to just let the audience know that if you all have any questions, feel free to drop them in. My question is kind of a curveball, but it's one that I'm personally curious about from your respective perspectives. If someone wants to get involved in venture capital or early stage investing, it can seem really, really overwhelming. I think a lot of people think about it, want to get involved, and they don't necessarily know how. So I'm going to throw it out and see who wants to grab it. But for the Silicon Slopes community or anyone listening in today live, if someone wants to learn more about venture or to actually start cutting checks and to get involved, what is some advice and almost like a plan for how someone can start getting involved on the investing side?
I guess I'll jump in since I would say reach out to those that have done it before. Find, whether it's somebody that'll mentor you or somebody in the space, don't be afraid to, shoot somebody an email and ask them to go to lunch or coffee and pick their brain and, have somebody, essentially hold your hand through a little bit. I would advise against jumping in and just starting to write checks. I would say find somebody that's been there and done that and done it successfully. Somebody that's gone through, a couple acquisitions, grown the companies, potentially taken some good exits. So I would say, don't be afraid of asking dumb questions. I don't think it's such a unique space and every deal is so different than each other that I wouldn't say there's a stupid question that you could ask. So, ask as many people as you can, the questions you have and how they've done it, because we've all done it completely different than each other. We've done it from kind of a former C-level employee perspective where Greg was very new to the VC space. I come from an investment banking background. So we didn't have a ton of experience in this, but we adapted and found what we were good at. And we're different than, a lot of other groups, I would say.
That's great advice.
So one thing I'd add to that too is I have a great example of a senior associate that works for me who's always networking. He's just always networking. He has lunch with people, every week, just in the valley and in the space, and he's just getting to know people, and that's a great start to because what's happened over time is he's built this network of individuals, and they're like, you need to come up with an idea because I want to invest in you. It's almost like it's a really interesting scenario. But at the same time, when there are ideas that come up and stuff, he can go to them. Most of them are successful in business. Most of them are investors that would like to invest themselves. And so I found that, his networking has created so many opportunities for him. But then I'd also say, he came to us right out of school and just got involved with us at Wasatch. And then he took a few internships at some private equity firms, one in California, one in Salt Lake, and he got some experience for 3 or 4 months, and then he came back to us, and he was even that much more valuable. And so, I think you get the experience where you can. I agree with Nick. You don't just jump in and say, hey, I'm going to raise money from investors and lose their money, because that won't work out well for you. Get the experience, get the network, and just kind of work your way into it until you create that opportunity. So Anu probably has something else here.
Yeah, I agree with both of you. And I think I was going to mention, typically how I've seen folks get into venture, and its background, such as coming from the financial world, right, investment banking or other investment roles. Like Nick, I also started my career in investment banking before I joined a growth equity fund before coming to Stage 2. So I come from that background. There's also a lot of operational leaders in industry that enter the venture space, and that's because they have such deep expertise in various operational fields that is highly applicable to investing and supporting companies as they scale. Right. So in Nick's case, the founder at his firm, came from the prop tech market, or in Scott's case as well, very deeply involved in the prop tech market. On the Stage 2 team, some of our partners are former operators and leaders in the go-to-market function. So that's one way that become really, really good at something in your respective field, and then do the networking, meeting others, and try and find those opportunities. And often it starts informally, right? Find opportunities to become a mentor to another company, to another founder, be an unofficial advisor. It could be an official advisor, or maybe even a board member, right? Depending on your expertise. That's a really great way to start too. And then the third thing I'll layer on is that increasingly there are a lot of resources just through the democratization that the internet allows for to learn. And there are YouTube channels being started by VCs to really teach others. I'm sure there's a lot of stuff on social media like Facebook, Instagram, TikTok, etc. I would say grain of salt, make sure you read up on the background of a person and feel like, yep, they are an expert in that field. That there's also a lot of folks that are, just trying to create influence without the substance and background. So be careful. But there's absolutely content online. And at Stage 2 as well, this is something that we do. We have a blog. We have a sister community that Mike referenced called Emerging Leader Syndicate, where we work with up-and-coming leaders in industry that want to just get started or are still growing in their careers, and we work with them to kind of help teach them the ropes and provide access to some of the deals that we see as well. So something that you can check out on our website, and we're always looking to hear from folks.
That's cool. I think it's such an exciting time. It's such an exciting thing to be involved in. And I think that advice was gold. So thanks, guys. We got one last question live. And the question is, how important is IP, intellectual property, and particularly patents for a startup to get funding? I'm not sure who feels best suited to take this one on, but I'll lob that to the group.
I can take a first cut, and then maybe Nick and Scott can layer on. But I would say it depends on what end market this idea is. So for example, if somebody is a founder in biotech or material science or some of the call it harder sciences or physical sciences, I would say patents and IP are very, very important, because that is the foundational bedrock, right? So Moderna, for example, innovators in mRNA, and that is a very, very important part of why they have become so successful. I think in software or internet-focused companies, it's less relevant. One reason being that there's just a lot of things that are not patentable, or so from a legal standpoint, it's less important. And also, there's things like Facebook's newsfeed that Facebook didn't invent the newsfeed, and there's other companies such as LinkedIn that also use a newsfeed. So it's really hard to have a legal kind of protection on that. But what is important is, I would say, creating moats around your product and technology. We often challenge founders on why is the way you're doing it highly defensible? And so having good answers to that, right? There's some unique insight, or when there are network effects, that's often the moat, for example. So think about that. So just to quickly rehash again, if it's a physical science company or a hard science company, IP protection matters a lot, really important. For software, internet, more distribution type plays, it's more about what are the moats and sustainable advantages you're getting.
Any differing opinion there, Scott, as it relates to what you're seeing, or is that pretty well aligned with the kind of vertical side of things?
It's exactly how I see it. It's almost, I'd almost say it word for word.
Okay.
How we see it. And where we deal a lot more in software, it's not as big of an issue for us. The one thing we do like to look for, though, is kind of that ownership history, though, making sure that early developers and things haven't gone off and taken that IP with them somewhere, that you have ownership of that IP and your code. That's an important thing. And if they've outsourced, making sure that they had the proper controls, in place to make sure that there wasn't access given to their complete all of their software code and everything else. But even that software changes so quickly. I mean, I can look at Red Dynamics, for example, what they were when we started 10 years ago versus what they are today. Like, it doesn't matter as much what the code was back then, because it's just so different now. But the ownership throughout the process is important. So
awesome. Well, those were all the questions that I had for today. We did receive 3 live from the audience today. While we wrap, I'd love to hear just the last from each of you. If someone has a question or wants to get in touch, what's the best way for someone to do so? Let's start with you, Scott.
I'd say reach out to me on LinkedIn. That's a great way to do it. Connect with me on LinkedIn and then reach out, send me a message, and I'll respond. And I'd also say that, we really are strategic investors. That's where we fit. We are early stage strategic investors. And so a lot of times I'll get approached with good ideas, but we don't add any strategic advantage. And so it's hard for us. But if you're in this space that I'm kind of talking about, and you'd love to pitch an idea to us, we're open. We're even considering creating a startup studio, and because there are so many good ideas, and we have resources under the Wasatch Group, which I didn't get into too much, but development resources. We have accounting, IT, marketing. We've set up these divisions so that we can quickly invest and then take some of that administrative function off of these companies, because they do get bogged down in it. So if you're stuck saying, I can't do the accounting, I can't do the IT, I can't do the HR, well, contact us anyway. So
awesome. Thank you. We'll go Nick, and then we'll close with Anu.
Yeah, I'd say the same thing. Is just reach out to me on LinkedIn is probably the best way to contact me. And, like I said, I like to look at as many deals as I can. Whether that's not a fit for us now, it could potentially be a fit down the road for us. But even if it's not a fit for us, I'll give you some feedback and my personal advice on it too. So I'm willing to look at anything.
Awesome. And yeah, similar for me, guys. Hit me up on LinkedIn. I'm just going to drop my email into the chat as well. So there's that, and then our website as well. You can find resources to get in touch with us through that platform too. And something else I think that's always fun is if there is a shared mutual introduction or someone that overlaps in the network. That's always really good to reference. And in this case, right, it's going to be, hey, we heard you on a panel at Silicon Slopes, and that's like a great reference point of, cool, you heard the panel, you were there, and it sets up immediate context.
Awesome. Well, hey, I thought we'd maybe last like 30, 35 minutes. We went 49 minutes today. This was super fun. I appreciate the time commitment and investment from each of you and everyone who joined us live. Thanks a ton, and we'll talk to you all next time.